Next year is not looking any better for the stock market than 2011, according to market analyst Roger Montgomery. Commodities such as iron ore and mining stocks will be hardest hit as growth slows in China. He says it's been a bumpy road on the share market this year.
Yes, it has. After we all looked really good earlier in the year and the market hit its high in April, but since then most indices are down between 18 and 20%. And there's been a lot of negative news, not only in terms of prices, but in terms of business performance.
So what's in store for 2012?
The United States appears to be slowing down despite all the contrary indicators. They can't grow without Europe growing, and Europe looks like it's heading into a recession. For Australia, though, our biggest customer, China, for our iron ore and our coal, they look like they're slowing down as well. There's an increase in non-performing loans. House prices in some areas have fallen by as much as 30%, and construction is slowing. That's going to reduce demand for our iron ore. That's going to reduce demand for steel. That means that profits for our single cylinder economy are going to decline, as will tax receipts for the government. We already know that retail is doing it tough, and I suspect after everyone pays off their credit cards in January, it's going to be even slower.
What about commodities like oil and gold?
People like Kyle Bass and Jim Chanos, Jim Rogers, some of the world's leading hedge fund managers with billions of dollars under management and billionaires in their own right. If they're right, then we may see the gold price go up a lot, but that will require a major default in Europe. And these guys are suggesting that could happen.
So what stocks or industries do you think in particular may perform well next year?
Out of over almost 2,000 companies that are listed on the Australian market, we can currently find 9 that are meeting all our criteria. And we own most of those 9. And what that means is that we've got a large proportion of our fund sitting in cash. That's helped us this year, and I suspect that'll help us again next year. The healthcare sector seems to be the most expensive. The retail sector appears to be some value, but we've got to wait for earnings forecast to drop meaningfully. Analysts are currently forecasting 9% earnings growth, and I just think that's too high.
Roger Montgomery, thanks very much for joining us.
It's a pleasure.